Apologies for the lack of uploading. I'm happy to announce that I did pass the exam I was writing, and I'm one step closer to getting my professional designation in accounting, so apologies. Today we'll be going over what I'm thinking the current US stock market being a bubble searching for a pin. These are the topics that I'll be going over today. Again, these are just my personal opinions, not recommendation for investment at any kind. Please do your own research. Your wealth is your responsibility. So first off, let's take a look at one of the indicators called the Buffett indicator, something that Buffett liked to use to compare if the US stock market is overvalued or not. Now, which is just US stock market cap over US GDP. As of today, it is 1.8 times, so 180%. The height of the dot-com bubble was only 1.4 times. The mean from 1950 to date is only 0.7. So we're looking, according to this indicator, we're looking at a fairly overvalued US stock market, higher than the dot-com bubble, as the stock market continues to rally up, making new all-time highs, while the US economy is actually still suffering if you look at GDP. Now, I'm thinking that this is a bubble searching for a pin, and we're just waiting for the next catalyst before a big leg down. Perhaps more lockdown news, maybe Andrew Cuomo in New York pushing for more lockdowns. Just recently, he mentioned that he's putting more restrictions on dining, maybe some vaccine delays, or even side effects that is causing people to have doubts against these vaccines, or just any economic data that looks way worse than what the street was expecting. Perhaps something in unemployment with the first filing the data that comes out every weekly. Speaking of the bond market, a lot of people are pointing to that there's no inflation concerns, and whatever the Fed is doing has no indication of inflation. And they point to the bond market saying, okay, for example, if you're a bond holder, you are expected to receive a fixed amount of payment. So if you have an anticipation that future purchasing power of that currency will go down, you would demand a higher yield. And with the yields being this low, there can't be any inflation. Well, something they're ignoring is that the Fed is actually manipulating the market, meaning they're in there aggressively buying. Balance sheet just rose. The Fed's balance sheet just rose to 7.2 trillion in the latest week print. And in terms of pricing, not only are the investment grade bonds near historic high, meaning low yields, high pricing, because inverse relationship, junk bonds are actually also near their historic highs. And so that puts the credit rating in question, where a lot of the investment grade triple B bonds, maybe they should be junk instead. Now, credit rating is actually a big impact to the pricing of the bonds, where if you get a downgrade, that really impacts the price. But the bond market, I think what is happening is a lot of the bond market investors are searching for yield that they can't find in the bond market. And so either they're going lower in terms of quality, so going into lower investment grade bonds or even into junk bonds, or some just left and they're searching for high dividend yielding equities in the stock market. And these guys are buying into something that they don't normally buy into, and they cannot suffer a big loss, a big fluctuation in equity prices. So if there is any big changes or a big drop, I think that their exit will be very, very quickly, because these institutional investors are investing for like pension funds, um, other big mutual funds. Like they cannot take big losses, so they will exit. I don't think they're gonna hold out. Now let's talk about the IPO craze. This is also another indicator of a bubble where, so in terms of IPO funding in 2020, there's been 140 billion and only 107 billion in 1999, which is, the part of the dot-com bubble. And in terms of the number of IPOs, there's 450 so far in this year and 46 in 1999. This is compared to only 159 in 2019. And the IPO sectors are led by financial, and then tech, healthcare, real estate, and then transport. Now, some of the recent examples are DoorDash and Airbnb. And if you actually take a look at their IPO price and then the performance right after, pretty much it's mirroring, where they make much higher than their IPO, like the open ticket is much higher than their IPO price. They rally for about midday, maybe a day or two, and then they both come crashing down. And that's because investors are not buying for their businesses, but rather they're just buying it to sell to the next person. And they're hoping, some fool, like some bigger fool, will come in and buy their share. So no one's looking at fundamentals. Everyone is just buying in an opening ticket, or or if they got lucky and got the IPO, and then immediately turn and sell it to the next person. Not only have these businesses been existing for a long time, they've been generating losses every year. Now, DoorDash, maybe that makes more sense in a pandemic environment. Maybe they're getting more businesses because people are not eating out, so maybe they're getting a lot more deliveries. So maybe they're doing better now during COVID than not COVID times. But Airbnb, how in the world would they be performing better in a COVID environment if comparing to if they weren't? So, why are people buying into Airbnb? No clue, but I think valuation is definitely an issue. I'm sure this will upset a lot of people, but something I got to talk about. I just don't see it with Tesla. From my personal opinion, I have no doubt they will survive, especially after the funding series that they have. But in terms of their valuation, I don't see it at all. I understand they're not just, people think, oh, they're not just a vehicle maker, because their revenue pretty much generate also from carbon credits as a big part. Because if you actually look at profit and loss, the losses have actually been increasing if you exclude the carbon credits in revenue. So funding in 2020 so far has been 12 billion. That's crazy. Their cash on hand, no other automaker has 20 billion on hand for cash. They by last so third quarter, by September 2020, they had 14.5 billion, and then and recently December 8th, they just filed for more share offering for 5 billion more. So I expect with operations they should be looking at 20 billion for end of the year. Market cap is sitting at this is as of yesterday, so December 11th, their market cap is sitting at 578 billion. This is greater than the next 7 automaker combined. We're talking about Toyota, Volkswagen, Daimler, BYD, GM, and NIO. Just somehow NIO got up there. So in terms of market share, comparing to these guys, you can't compare. Like Tesla is nowhere near, but somehow the market cap is greater than all 7 of them. Meaning, you can either buy Tesla or you can buy these 7 other automakers. So, and other items including internal email with Elon Musk sending to his employees, warning about the recent stock price. Be careful that there might be a big fluctuation soon, might be overvalued. And Michael Burry, famous from The Big Short, he mentioned publicly about his shorting position on Tesla and his Twitter advice to Elon Musk saying, hey, you should take advantage of the investors being, silly and pricing you in such ridiculous valuation, and you should issue equity, and which he did later on, which was the 5 billion more, which is really funny. So even Elon Musk understands, investors just giving the money away. So, you got to be smart and take it. That just shows you that even the owner understands the stock is being overvalued, and investors are still somehow piling in and not seeing the problem at all. So I think Tesla is going to be one of the, when we see the next leg down, Tesla is going to see a big drop. That's just my personal opinion. Now let's go over some suggestions. First off, for most people, I would just say increase cash position, be more liquid, sell or at least trim a lot of your higher beta investments. So your momentum stocks, your like bigger names, like something that's really correlated to the market, or something that you've seen like a big gain this year. So increase your liquidity, at least trim some positions. Your like paper gains is paper gains until you actually sell. So shorting is also another option. It's very dangerous because losses can be infinite, but gain is only limited, because when you're shorting, the maximum you can gain is, if it goes to 0, then you just gain whatever the market price minus 0 is. So whatever the market price is. But losses can be infinite because the stock theoretically could go to infinite. So shorting, very dangerous. I would not recommend it unless you know what you're doing. Really make sure to limit your losses. So you, for example, you can pick the biggest stock in the index, high beta, set a stop loss at all-time high. So since most stocks are like, those ones should be the ones that you're picking, are near their all-time high, your losses theoretically is minimal, but your gain could be massive if it drops 20-30%. Another example could be inverse ETFs. Obviously this one is a bit more lazy. It picks the index most of the time, or a specific choice of sector, etc. There's also management fee. There's also a lot more complication with ETF, but this is if you want to, instead of shorting it, shorting a specific stock, an inverse ETF could still do the job. Obviously it's more costly because of management fee and etc., and you don't have to worry about being closed out by your broker if, let's say, the broker ran out of that specific stock, or their client is selling, so you have to force buy back. So options. Commodities update. So oil, we saw Brent crude high of 50. It's now it closed below like 50 cents, so 49.50. The oil excess supply, that it has been the question recently, in term when the oil price have been increasing. The IEA, International Energy Association, they're having trouble to locate 0.9 billion barrels of oil out of the 1.3 barrel of oil that is on paper as excess supply. And it looks like maybe China has it, where oil gets shipped to them, so the export uh, documents it, but once it gets there, the import data doesn't show it. So who knows where the storage is? Uh, Maybe it'll come popping out uh, someday soon. And then if that excess supply is actually there, maybe oil takes a leg down. So we'll see if Brent can actually hold 42.80. Uranium, the commodity price didn't really change. I think it's still at 29 last time I took a look. But equities have actually moved up from the US news. I think Trump signed a deal saying it'll increase its uranium reserves, probably for energy, hopefully. And I'm not sure if this is something that could last. Still, I think it might be a little bit premature, as we're not sure what Biden's going to do. But in terms of my opinion, I think as long as Biden fulfills his promise to go towards more green energy, I think the demand for more reliable energy will increase, because wind and solar, in terms of the power grid, not only do they use a lot of land mass, especially solar, they're also not as reliable, meaning like, okay, you're not going to have wind like 24/7. You're not going to have sun 24/7. And that's like one good thing about fossil fuel. You just burn as much as you need. And if he's trying to limit fossil fuels, but the renewable energy is not only increasing costs, but also not as reliable, like blackouts, I think nuclear should come into play. To continue with commodities update, agriculture, weather looks like we're having one of the warmest winters. So the El Nino impact, I think, is still there. Soybean and corn, I mentioned before, they got the rain that they were hoping for planting season. We might have to see until the harvest of 2021 Q1. My opinion is still that I expect inflation to one of the areas to start would be in the agriculture goods, which we have already seen this year, breaking like multi-year levels in terms of rally up. Wheat, Russia recently increased their production report, so that's bearish for the commodities, which we have seen it getting knocked down to 560. But it seems like there's been big buyers in the COMAX, so this is something to keep an eye out on. Finally, for precious metals, I'm expecting them to have found their 7-month consolidation bottom, and we're just waiting for them to break above the resistance levels to confirm that is the case. In terms of fundamentals, nothing has changed. There is still negative real interest rate. There is still government deficits and increasing government deficits. And so we'll continue to see. I think the resistance levels for gold will be 1860 and silver at 2460. So once they break above those clearly, then those will become support levels, and I think we're good to go on the next run. So maybe that would happen with December with the massive open interest in COMAX. Maybe a lot of investors are demanding delivery. We'll see how this goes. Finally, going forward, near term, I'm still expecting something to cause the market to sell off. We might see something like in March, where there's pretty much no bid at some times, and it's a big leg down every day. We see like few like 1,000 or 2,000 Dow drops. We'll see. Midterm, I'm expecting once the market gets a bit of correction, the Fed will ramp up QE and bring their balance sheet to 10 trillion. Right now, 7.2 at the latest print. The next stimulus bill will be signed because what they're fighting is not really COVID. They're just fighting for economic. They're just trying to fight recession. So it'll be signed. Also, because a lot of people are on the boat and everyone's thinking like, okay, we need more stimulus. That is what the economy needs. We need more government spending and money printing. So that's going to happen, especially with Biden coming in. He's for sure going to spend a lot more than Trump would have and did. So I'm expecting a lot more spending. Market should again see another rally as inflation picks up and I'm expecting it to pick up by early Q1 or mid Q2 of next year. But that is something I wouldn't bet my money on because we don't know. We don't know if it would actually rally back up, and if so, how much. Because from a very overvalued point of view, I just wouldn't get in. Most of my investment are in commodities, as I expect them to perform. Like I want to buy something that is out of favor. Finally, long term, I expect going back to the end game expectation. Inflation will get out of control. The wealth transfer plan will be completed, where it gets transferred from savers to lenders. And eventually, central banks will have to raise interest rates to control inflation, and it finally cause the Greater Depression. Again, thank you for listening. Best of luck in your own investments and financial freedom.